Welcome to Ben's Insights. It's episode 13 and it's the 5th of November. We've got quite a lot to chat about, notwithstanding the fact that clearly markets are nervous, bubbles are bubbling all around us. Investors are calling and asking if we are at the point where markets crash, led by the technology sector. Look at what just happened to Palantir. They blew the numbers, but the stock is down some 10% or so from the point at which they released their numbers. We'll come back to have that discussion. Other things we're going to talk about is the fact that there is a lack of economic macro data in the US, and that is clearly having an impact on people's nerves. We've got a potential concern by some investors that we're not going to see now a further rate cut by the Fed in December. It looks like the China and US tariff discussions have effectively settled on a scenario where we're back to pre-Liberation Day, i.e. full circle with no changes. This is very typical Trump. And a Supreme Court deciding whether tariffs are after all illegal or not. And again, we'll have a quick view on that and finally discuss on the micro side the results that have come through and whether technology is expensive. So apart from some benign CPI numbers in the US, we've literally had no data on trade, unemployment, etc. Where's the economy heading? We kind of know there is a pretty decent growth rate of 2 to 3%, but it would be nice to get some pointers and signals as to where this market is really heading. I think we're breaking new records in terms of government closure, and that's probably what's making these markets quite nervous. I do believe that we can look through this, that the unemployment numbers, I don't believe there's any new data that would show a distinct move away from the period of time when we last saw data coming through. In other words, the delta or the change is unlikely to be a very big one. So investors, not surprisingly, are nervous. I think we are going to get through this. And when the government comes back, we'll see that these figures are not very different to the figures that we saw pre-shutdown. So in terms of the Fed cut, will the Fed cut in December again by another 25 basis points? I'm of the view that we are in a rate cutting cycle. And so therefore, whether it happens in December or in Q1 at some point, it's going to happen. We are in an easing environment and risk assets will continue to benefit from that. From a perspective of a strengthening in the dollar that we're currently seeing at this point, I believe that that's a function of a feeling by investors that we're not going to be seeing interest rates decline. When we look at the US-China trade agreements, it's becoming very clear that Trump has come up against an adversary that he's finding difficult to quash. Clearly, China has leverage in terms of the rare earths and other products they send into the US. So I suspect that Trump will now go and try and pick on a country that is not his own size and see if he can get some success. China is clearly not an area where he is finding any success in terms of bullying tactics. The 10-year yield is still at 4%. Once we get clarity on the December rate cut or otherwise, I suspect we'll start to see that 10-year beginning to continue what it's done in the last 6 months, which is stay some half point ahead of where the Fed rates are. So we could, I believe, still see a 3.8 to 4% type of 10-year yield going into year end. And again, that is quite attractive for risk assets. Moving to the micro environment, Palantir, as we said, is down some 10% over a couple of sessions. They did blow their numbers, but the reality is that the stock has a consensus estimates for revenue this year of some $4.8 billion, but has a market capitalization of almost $500 million. That's 100 times revenues. There's going to have to be significant growth beyond the consensus forecast of 50% or so over the next 2 to 3 years to really justify that valuation. So It is very much an AI bubble. I don't doubt that it is a bubble in the classic sense, particularly as the CapEx announcements that have come through from the likes of Oracle, etc., are really kind of a closed loop exercise where Peter is paying Paul, vice versa. The results from last week in the tech sector have actually been very encouraging. Let's take a few of those Mag 7 numbers that came through. Google reported Gemini is actually working incredibly well as an AI platform, and it's increasing its market share in terms of search. So there's a level of protection there. The DOJ issue seems to be going away in terms of breakout of Chrome. And the Google Cloud platform is showing significant growth. The stock is trading on a forward PE of 23 times, pretty much in line with the market. Amazon reported AWS back at growth level, and that sort of went down pretty well with investors. Ad revenue growth is pretty flattish, but I do believe that it remains the biggest beneficiary in the ad market from AI spend. Targeting is key, and Amazon has the most amount of granular data on its customers and can therefore target product for clients in probably the best possible environment using its AI search platforms. And that's on 25 times. Again, small premium to the market. Meta didn't go down well with investors. Meta is down almost some 17% since it's produced its results, largely on the basis of continued heavy spend on AI. I think the market is slightly confusing the issue that the previous big investments announced by Meta went into the metaverse, a brand new area for them, and turned out to be red herring and pretty much a waste of money. And I think investors got very spooked that this is happening all over again. The reality is that this CapEx spend is going back into its core product, which is the digital ad targeting platform. Like Amazon, its digital platform is incredibly robust. They have hundreds of thousands of small and large clients, and the targeting that goes on within the Meta ad platform is very strong. And AI spend can only improve that. And this is not a brand new business. This is not a metaverse play. And so trading on some 19 times forward, i.e. a discount to market with 15% plus in earnings growth, is something that I certainly would see some upside still to come. Microsoft, very little to have to add here from what markets have said, but it's pumping on all cylinders 27 times. The premium is clearly bigger than the others I've mentioned earlier, but not in bubble territory. The one I was disappointed with, but performed very well on the back of their results, was Apple. China exposure, where it did see a decline in revenues, is a concern. I think that the replacement cycle shortening, or at least becoming more robust going forward, and services transition is somewhat already discounted in as much as the earnings going forward are on some 30 times or so, not kind of growth rates that we've seen in the other Mag 7 names. So maybe this stock starts to stall, and potentially the Mag 7 group starts to stall at this juncture whilst they catch up in fundamental terms with their valuation, and the broader recovery in the marketplace continues. But nonetheless, this asset allocation to the US of some 65% within global MSCI makes sense. I think that US exceptionalism remains, and the environment, as we've talked in the past, whether it's a big, beautiful bill, an implication of tax, a continuing easing environment, and deregulation is a positive. And I suspect that the US continues to outperform. And these weaknesses that we see in the marketplace when people get nervous continues to present a buy on the dips opportunity. Wishing you a great rest of the week, and we'll see you next week.